Hi, Mike Swanson here. I'm actually in the airport. I'm ready to take off and go to the Bahamas for a couple of days. It's just been New Year's. Actually, my birthday is January the 4th. And a lot of times when the year changes, I like to sit back for a little bit and plan ahead for the rest of the year because I got a lot of things I want to accomplish, and so I'm like trying to take a couple days break for a lot of big stuff that's going to go on. And one of the things I'm going to do is put together a couple presentations for you. One's coming right up. I think we can make a lot of money in the stock market, so I'll be playing that for you in a few minutes. And I'm going to get out of here so I don't miss my flight. I'm in the garage and need to get on the airplane so I don't have to come back here tomorrow or something. So I'll be talking to you later.
Hello, Mike Swanson here, and I'm going to talk today about what I'm calling Operation Make Money 2009. I know that sounds a little funny to you considering what happened in 2008, but I'm actually very excited about the opportunities I see in the stock market in the coming year. First, before I get to that and specific strategies and plans that I've made to make money in 2009, I'm going to talk about the lessons that we need to take away from 2008 because they directly apply from 2009. If we don't learn anything from what we just went through, it's not going to be any better. But anyway, most people learned the lesson from last year that you can lose a lot of money in the stock market. The S&P 500 was down 38.5% in 2008. The Dow had its worst loss since 1931. We also saw the worst one-week drop ever for the Dow in October. And for year over year, from October 2007 to October 2008, we actually saw a worse decline than occurred in those first year of the 1929 Depression era bear market. And people are now saying, and I've been hearing this for weeks and months since October, but what do I do now? Do I bury my head in sand and just hold on? Do I get out and sell and try to buy something else? Should I just be scared? What do I do? And I know this is what people are thinking because I'm getting this question nonstop. For example, I just want to show you some email I got today from somebody. They don't have their real name, so that's good. I don't think they necessarily want to give that out. They say, I hope you're enjoying the holiday season. I would like to ask for your expert opinion regarding investment strategy. I recently saw your most recent video which shows you sitting down with another person going over the chart of the stock market. In it you talk about the bull market runs and also bear market runs and the phases in between. Now I've seen those charts before, but my broker would say you can't time the market because you're in it for the long term, and because markets always go up in the long run you need to stay the course. Well, after watching the video and listening to your take on what to do and what not to do during bear markets and consolidation periods, I now appreciate your take on the investments even more. And as you recall in this video, we talked about decade-long trends in the market. In the 1970s, the market basically went nowhere from 68 to about 1982. So anyone who is simply buying and holding, unless they just somehow happen to buy in on one of the bear market bottoms like 1974 or something, they were basically spinning their wheels that whole decade. And even this decade, anyone who's bought, for the most part, is now under the water, especially if you've bought in 2000. I mean, you got a lot of ground to make up. So almost everyone who's in the stock market has lost money. And in fact, when I look back and think about the people I know who actually have made a lot of money in the stock market, and that's basically what people are promising you by telling you to hold on for the long term, I don't know anybody who's made a fortune in the market simply by buying mutual funds and holding them. All the people I know that made big amounts of money in the market have done so because they've educated themselves about the market and have made good investment decisions, which includes knowing when to sell and take a profit, or else they've simply lucked out and happened to, be in a good company and own stock in that company that's gone up a lot over 20 years or something. So anyway, let's go on to the presentation. I don't want to talk about that because he goes into some specifics. He sent me 3 emails, and let's talk about his last email. Basically, he says, what do I do from this point on? Should I wait for a mini bounce and then sell some or most of my positions before the pullback and then try to follow with your future moves? In other words, should he engage in market timing, sell out on a rally and try to buy on a dip? Or am I better off sitting as I am now with my current positions and try to add new positions with my monthly deposits in a regular and IRA account? My monthly IRA would be around $3,000 to $4,000. I'll also be adding into a regular account. What I'm afraid of is another significant drop in the market that would damage my current holdings even further. Thank you in advance. I apologize that this kind of question is not appropriate for the website's intent and purpose. Well, I can't really answer people's specific investment questions when it comes to their own investments because I'm not a registered investment advisor. But I can speak in general terms, and I'm doing that by using this as an example to talk to everyone at once. So anyway, as far as market timing, I'm going to talk a lot about that a little bit later on in this presentation, because market timing is something I really was a main strategy of mine in 2008, and it's not going to always remain that way. In fact, at some point next year, I'm actually going to abandon market timing and go into timing specific stocks and sectors, and I'll explain that to you later. But the basic question here, to me, it's showing me I'm afraid of another significant drop. I'm thinking of selling and this kind of stuff. And this is really important because this is basically the gist of the emails I'm getting from people. And the way I see it, people are asking the wrong question here. Instead, they need to be asking me, what do I need to do to make money? How should I invest to make money? Not, do I need to sell right now so I can buy back when you recommend later? They're really asking me a fear-based question. And the problem is, let's say I could answer this question perfectly, that I could tell this guy, you need to sell out on January the 18th, and then we're going to watch the market decline, and you're going to buy back in exactly on the low of, let's say, April or something. And bam, you just saved yourself some money, and now you're in a good position. But the problem is, you need a strategy of your own to make money in the stock market. In market timing, you can't completely rely on that. Now, I certainly don't advocate a buy and hold strategy where you just buy and that's all you ever do. You never sell, or you never incorporate any market timing. But the problem is that if I could just simply give someone, the perfect sell point and then the next perfect entry point, at some point I'm going to be wrong. And you have to incorporate risk control into your strategies. You can't just simply rely on one person. What I try to do is not just tell you only why I'm doing something, but show you, I don't just tell you what I'm doing, but try to explain why so you can understand what's going on. So anyway, to me, what I learned from last year reinforced to me the importance of sticking with the big trends in the market. And that meant we had a bear market last year, and you had to adjust to that fact. And this year, at some point, that trend's going to change. We're going to have to adjust again. And I know most people did not do this at all, and that was the primary mistake that people made. The thing you need to learn isn't how to exactly time the market in order to make a lot of money in the market, but you have to learn two basic things: strategies for getting into stocks and sectors, and when to sell and so forth, but also how to align specific trading strategies and buying strategies with the big trends of the market. And last year was a bear market, and if you didn't adjust your strategy to that fact, you lost money. I did. I made money. A lot of my subscribers made money, but it was because of this. And here's the thing. I'm not perfect, and the reason why I made the adjustment is because I actually made this mistake in 2003, and I learned my lesson then and knew not to make it again. And what happened to me was in 2000, I turned bearish on the market correctly, made a lot of money over the couple years, and then 2003, I didn't switch. There are all these signs, and I'm going to go through some of them with you today, that show me a new bull market was coming, but I ignored them. Luckily, I actually still did good because I was in gold stocks, and gold stocks actually went up more than the broad market. So it didn't hurt me, it didn't really hurt my subscribers, but I talked about the bear market being there that wasn't there, and I had some biases that caused me to do this, and people had biases last year that caused them to ignore reality, ignore all the signs that pointed that we were in a bear market. And I learned my lesson and made sure I never made it again, and that made me realize the key lesson was here's these technical signs that you have got to pay attention to and recognize when the big trends in the market change and adjust. And I didn't do that in 2003, and that made me know to be sure I did it last year and really the months before that, and know I do it again in the coming year. And that's really what this presentation today is going to be about. But the thing is, people do not do this at all. They simply buy and pray or buy and hope. And the reason why they do this is I believe they don't want to take responsibility of, I misspelled this, just ignore this. But they don't want to take responsibility for their own money and their own actions. Instead, I think they simply dabble in the stock market instead of committing to success. And here's the key thing about this. I'm just going to use this example of the broker. Most people in the investment community, in magazines and literature, on television, the whole Wall Street industry is geared to telling you to buy and hold. And the thing is, I believe that everybody has biases built into them when it comes to investing, and these biases are based on psychological desires and needs, and they can make them deny reality. And that's what we saw about a lot of last year. But there's also another thing where people are in a position, and a broker is in an important position, and a mutual fund advisor, investment advisor, where they're dispensing investment advice, they're managing your account, they're in a position of managing money. And what that means is that their goal in that position, their overriding goal, is to make money from managing your money. That's how they make a living. Well, to do that, they need to keep you happy as a customer. If you're unhappy, you're going to go to someone else. How do they keep you happy? Well, here's the truth that no one's ever told you probably. They keep you happy not by making you a whole lot of money. They keep you happy by making you money when the market goes up, and when the market goes down, by holding your hand. That's how they do it. And what that means is the goal of an investment advisor or a mutual fund guy, they may not ever even have thought of this. They're just in a social position, which, they're trained when they get in the business to do this, but they're also in a social position that completely reinforces this type of behavior because they're dealing with your psychological pressures. And they have been trained by all this to believe in the buy and hold strategy. Because here's the thing, if you're a broker or investment advisor or whatever, and you decide, I think we're going into bear market, I want to help my clients, I'm going to call them all up and tell them, we got to get out, the market's going to fall, and the market goes up anyway, they're going to lose everybody. And they're going to piss everyone off, and you're going to go to someone else. That's the worst possible mistake they can make, is to miss out on the market going up. So what happens is they inherently have a bias of wanting the market to go up all the time, and they simply hold and tell you to hold and so forth. And if the market goes down, as long as you're not getting totally wiped out and everyone else is losing money too, you're not going to actually get as upset as you would if they missed out on a rally. So that's why buy and hold is the predominant investment strategy, and why everyone is for the most part, 90% of the traders and mutual fund managers, hedge funds, is simply a giant herd. That's it. They're all doing the same thing. And this is why, I also always get these questions. Well, you got all these techniques, or other techniques people tell me, why will they ever work? Why won't people just copy them all if they're so great? Well, I'm telling you why right now, because the whole investment community is one giant herd, and they aren't very good at making lots of money in the stock market. Instead, they simply basically try to match the averages is what they end up doing. And that was one lesson I took from last year, was the incredible incompetency of the professional money managers. If anything, two things really show that to us. One, the blow up of all these hedge funds and the stupid mortgages they bought and the banks bought because all the other guys were buying them. And then this Madoff hedge fund scandal, this $50 billion or whatever Ponzi scheme. The thing that shocked me about it was so many fund of funds to put money in there on behalf of their clients. They did no due diligence. They should be able to recognize that this was a scam. And that showed me how incompetent the professional money manager community is. And that's what last year to me really drove home. Now, over the past few weeks, I've been revisiting my own trading history and thinking about trading psychology. I actually got out of the market for the most part after taking profits in some short positions late in September, and sat and watched the crash and made one or two trades I quickly got stopped out of, and I just sat in cash really up until recently. And I use that time to write and think about trading psychology, and I'm going to put out a product about that sometime next year. But it's made me think about that, my own history of trading, and really plan ahead for next year. I'm really excited about that. But to make a long story short, when I started out trading, I was like everyone else. I was just dabbling in the stock market, not committing myself to real success. And that's what everyone does for the most part. And I want you not to do that. I want you to be successful and not be just a dabbler like everyone else. Well, what happened to me was I was just doing random strategies, and basically start out $15,000, grew it into about 50 by pure luck, and turned that 50 into 7 because I was a market dabbler. And what happened to me is I was in a position where I was going to either have to recognize that I was dabbling in the market and not taking this seriously at all, and I was going to have to stick with investment strategies that actually worked and would align myself with the real broad trends in the market. Basically, I sat down with myself one day and I said, look, I've got to make money in the stock market. And this is what I think everyone needs to ask themselves now, not like, oh, I've lost 50% of my money, I'm scared, what do I do? The question you need to ask yourself is, how do I make money next year? Not, what do I do with my account right now? You need to learn how to make money. How do you learn how to make money? You ask yourself these two questions. One, what is the broad market trend? Learn how to detect that, which I'm going to show you. Learn how to know when it changes, which I'm going to show you in this video. And then you're going to have to say, what is the best strategy I can use that will align myself with the broad market trend? And I'm going to talk about that too. And last year, that strategy was market timing to short market rallies and cover on the dips. So market timing was very important, and I talked about it a lot. This year, actually, market timing is still going to be important, but as the year goes on, I expect it's going to become less important. So at some point, maybe a year from now, I may not hardly talk about market timing at all. I might be mostly focused on stock trading strategies to use in the bull market, but we'll see. But anyway, after a market drop like this, eventually we're going to get incredible market opportunities that line up. And what you need to know is understand what the trend of the market is and what the best way to invest in that trend is. So these are the lessons to take from 2008. Now, 2009, I'm going to, once I get this right, okay. 2009, I see, is going to be a year of transition. Last year was a bear market year, and 2007 I saw as a year's transition. And I'll show you what I mean by that in a moment. 2007 was a year of transition. 2009, when it's over, I believe will become another year of transition, a transition period between a bull and bear market. And there's some strategies that we're going to have to employ specific for such a time period. In 2007 was a transition period, and these transition periods have a certain pattern to them that tell you when a new bull market is about to begin. It is that moment that you want to really start to get fully invested in the stock market and in the top stocks and the top sectors. And how do you know when to do that? Well, the core of all this is what I call stage analysis. This is what I mean when I'm talking about the big trends. It's what big stages in the market and what's the year trend or 3-year trend. And to show you what I mean by this, here's a simple chart. This is stage 1. It's a consolidation phase. It follows a stage 4 bear market. Stage 2 is a bull market. Stage 3, which is usually the shortest stage out of all of them, is a bull market peak. Stage 4 is which we had last year, was the bear market. 2007 was stage 3, 2008 stage 4, and I believe we're probably here or something in the bear market. I see a good chance we'll have one more low, and then some sideways action, which will lead to a new bull market. So anyway, this is a chart from 1999 to 2008. I'm going to show you how these stages work. This is the 150 and 200 day moving averages, and they have a certain pattern to them, just like you saw here. So you can identify what stage you are in by looking at the moving average. Is the price above it or below it? And of course, last year it was below it the whole time. And I talked about this over and over again, and incredibly, people ignored this. I mean, this is a basic of technical analysis, but people did not want to accept the fact that we were in a bear market, and we're still in a bear market, or at the end of one and going into a stage one. But either case, we're below these moving averages. We're clearly not in a bull market right now, despite what anyone says. I mean, I've heard people say that this must be the bottom. I heard this on CNBC. So they're thinking you must load up in stocks right now. Well, if you load up in stocks right now, what's going to happen is you're going to go through this. You're just going to go up and down for 3 to 6 to 12 months, and you're not really going to make any money. And more importantly, you're not going to know what the best stocks and sectors are to buy in the next bull market, and that's where the real money is made. What you're really going to do is match the performance of everyone else, and I'm not interested in doing that. If you're interested in simply matching the performance of everyone else, what I recommend is you go and just buy some ETFs, where you're not going to pay the trails that you suffer when you buy a mutual fund. I really think mutual funds are junk, and unless you're specifically trying to buy into some mutual fund because it focuses on a single sector, a mutual fund that just for the broad market, I believe, is garbage, and you should just buy ETFs because you don't get the trails. You don't have to pay those fees. But anyway, bull market, bear market. This was the stage one consolidation period that started from July 2002, ended in April, and we're going to go through some sort of phase like this probably this year. I certainly would expect so. I do not believe the S&P 500 is going to 200 or something ridiculous. So anyway, this was the bull market, and it came to an end in 2003, and I'll show you in a second what happened during this transition phase, because it's very important. And of course, we had the bear market. Now, as I said, we are either in the very beginning of a consolidation phase or about to enter one sometime this year. And since we're about to enter one, that means we could actually see new lows. Now, before we do that, now I want to talk about how do you detect a change in the stage or the big trend. In particular, right now, I'm going to talk about how can you tell when you're in a topping phase, and then after that, I'll talk about how do you know when you're in a stage one consolidation phase. First of all, the topping phase. There's one real simple thing to focus on, and that's the advanced decline line. The advanced decline line is simply the number of stocks advancing, the number of stocks declining. The New York Stock Exchange is the most broad-based one. And what happens is, typically in a stage two topping phase, that's a prelude to a new bear market, most stocks and most sectors actually top out ahead of the broad market averages and start bear markets of their own. And that's exactly what happened in 2007. This is the advanced decline line for 2007. It tapped out in July. The actual market top was about right here for the broad market, for the NASDAQ in October right here. And then the bear market was in full force. This is the S&P 500, a weekly chart. That's what you're looking at. But the key is that most stocks and sectors started bear markets of their own. And not only do I look at the New York Stock Exchange advanced decline line, the other advanced decline lines too, but just and more importantly, I also use TC2000, which breaks the stock market up into about 230, 250 sectors, and I do stage analysis on them. And typically what happens in this stage three topping phase is more sectors go into bear markets way ahead of the broad market average is doing that, and that's what happened in 2007. In fact, something like over half the sectors were in bear markets way before the rest of the market was. And I've pounded the table on this fact in November, December, warning people, bear market's coming, we're going to switch strategy and start shorting, and a lot of people took heed in that. And now we're going to be looking for the exact opposite to happen in the coming year. We're going to actually look for the advanced decline line to firm up ahead of a bull market in the broad market averages. and we're going to look for the sectors to firm up ahead of a bull market in the broad market averages. What this means is that there's going to be individual sectors that enter bull markets ahead of the Dow and the S&P 500 and the NASDAQ. So in other words, if you can simply identify that and invest in that, what's going to happen is you're going to be entering a bull market ahead of everyone else. While your buddies and whoever are holding on their mutual funds, hoping that they're going to go up, you're actually going to be going into things, buying stocks, buying into sectors that are going up ahead of your neighbors. That's kind of what everyone wants. I mean, I don't think of it that way. I want to make money in my own account, but that's why people behave the way they do when it comes to stock market, and they don't take the commitment necessary because they're not really committed to making money in the stock market. They're committed to making money in the market when everyone else does, and to me that's silly. But anyway, now let's look at what happens in a stage 1 consolidation phase. It's a prelude to a bull market with the advanced decline line. Now this is 2002 S&P 500 weekly chart, bottomed about July, new bull market started in April. You actually had a lower low in October, a really minor one, in consolidation that led to a new bull market. And this was the consolidation phase. And here's the thing I want you to note. In a consolidation phase, in the very about first half of it, you actually, I believe the best way to still make money is to continue the market timing that you did in a bear market by shorting rallies. And usually you get one rally in a consolidation phase which is shortable, and you simply should cover once the market makes a new low or you start to see panic creep in and take your profits. And then you shift your attention to starting to buy into the bull sectors. Not buying into the individual market anymore, or time to time, actually even abandon this market timing that I think was useful in the bear market and start trying to time individual sectors. But anyways, you can see there was a divergence that formed between the advanced decline line and the broad market averages. The advanced decline line right here in particular started to outperform the broad market, which was a sign that individual stocks, individual sectors were now acting better than the S&P 500 and Dow and the NASDAQ, the three major market averages. And that was a sign that there's massive accumulation and the stage is being set for a new bull market. And this is what we're going to be looking for in the coming year. This exact same pattern should happen at some point in 2009 and lead to a new bull market, the start of a new bull market at some point, probably in the last third of next year or in 2010. That's what we should see, the beginning of a new bull market. But we should start to see some individual sectors, individual stocks enter bull markets of their own way ahead of the broad market. And so basically my focus is still, although I have dabbled in one sector in particular, which I'll talk about probably in the next video, at the moment my focus is still on possibly one final short trade on a market rally. But then at some point, probably in the spring, my focus is going to shift to buying individual stocks with a somewhat buy and hold strategy of, a year out, possibly 2 or 3 years out. And that's basically going to become my main focus at some point next year. Gotten ahead of myself. That's my sector rotation strategy. Well, right now, we need to talk about this. There's one sector, and I'll talk about it in more detail in the next video, that I believe, I actually mentioned it in the last video, it's the airline sector, but this one sector I believe is bullish, configured, the most bullish right now, is the most potential to go into bull market. I'll talk about it in more detail in the next video. But here's the key thing. I'm not really trying to tell you about this airline sector to pump you up about airlines. I do think there's a lot of potential in them. It's tough because the stock market still is in danger of making a new low at some point next year, so it's tough to really get too excited. But the thing that's real important is it's one sector, all right? And that means that the market has barely, if at all, begun its consolidation phase because there's only one sector. Once it gets halfway through the phase, there'll be dozens of sectors, and once it nears the end of the phase, the majority of sectors will be in a bullish configuration. By bullish configuration, what I mean is in a configuration where they look like they're about to start a bull market. Not that they're in bull markets, but they're about to start one. The airline sector isn't even in a bull market yet. It just looks like it has a potential to begin one over the next couple weeks. But the key is there's only one sector, and that has important ramifications. Because that means that in the beginning of a stage one, there's only a few sectors that are ready to go in a bull market. The advanced decline line can actually still be negative as it is now, and the market is still way below its market average, which is the case now. And the problem is that this pattern also fits bear markets, so it's not even really clear right at this moment. And this is where I'm going to go to my conclusions. It's not really clear at this moment that the bear market is over. On a technical basis, there's nothing I can point to and tell you with any certainty that the market has bottomed. Anyone who's doing that is simply guessing and hoping. And if you look at the news in the recession we're in, there's certainly no good news that you can point to. And I want to deal in logic. I want to deal in reality. I want to align myself with the broad market trends, not with my hopes. So, and that's what I talk to you about. I'm not looking to, here's the thing about me. All right. People see my track record. They can, I've had a good investment track record over the years since I began investing, except that, when I started out, so I had to learn from that. But even when I was wrong, I made money in the market. I haven't had a losing year in the market. Actually, even the first year I was in the market when it was in may have been a winning year. But either way, after that first year, it was over 10 years ago. I've not had a losing year in the stock market. I beat the market, and every year I really, but I think one I didn't. And even that year where I was most wrong, 2003, I was most wrong about the market. I thought we were still in a bear market until, months after the bull market began. I still made money because I was in the right sectors. The point is, people know my track record. They follow my writing, particularly the last year. Made some great calls in the last year. I'm not perfect, though. You see, I can be wrong. And the thing is, I don't try to predict what's happening. I'm not trying to predict that the stock market's going into a bull market. I'm not trying to guess that the bear market's over. My whole basis of my own investing, and this is why I think I'm different than the typical money manager, talking head on TV, or even a newsletter writer. Because what I said about the biases about people who give investment advice or giving advice to people who want the market to go up and get angry if you tell them to get out and the market goes up without them, and if it falls they're not so mad. That applies to newsletter writers too. Because what will happen is, here's the key, a lot of people subscribe to advisory services because they want to get hot stock picks. And what will happen is, if they subscribe and the person was to tell them, here's my stock pick, then a week later come back and say, things have changed, the market's about to drop, I think this stock's no good, you should sell it, and the market went up anyway, they get viciously angry and unsubscribe and curse the person. However, if the market falls and the person, this newsletter guy, says, oh, the market's dropping, just hold on, the people don't unsubscribe because they're being told what they want to hear. So this whole investment newsletter industry is biased too, to tell people the market's always going up. The reason I believe don't have these, biases to my writing, or try not to have them as much as possible, is because the main way I make money is through my own trading and investments. I made 5 times at least as much from my own investments in the stock market as I did from my website and the advisory services. I do it for extra income, and I do it also because it helps me, it gives me a reason to think about the stock market all the time. It keeps me on alert, and I enjoy doing it and communicating with people, and there's more to life than making money in the stock market, and I like to write and so forth. But anyway, again, we have got to align ourselves with reality, not predict the future, align ourselves with reality, and that means just simply watching the charts and watching the things I just talked to you about today, so you know when the trend changes. All you got to do is two things: recognize the trend, recognize the trend, have a strategy that suits the trend, and then recognize when the trend changes. And I've just given you all the tools you need to know when the trend changes. In the next video, I'll talk about strategies to use to pick out the individual sectors that are the best ones to buy at the best time to buy. That's what I'm going to do in the next video. Probably come out 2 or 3 days. But once the bear market ends, another conclusion, once this bear market ends, if it is not already, and again, there's no evidence to say with certainty that it has, but once it ends, the market will enter a 3 to 12 month consolidation phase. I've just given you the strategies. We need to deal with that, and that's probably the most important thing you need to take away with right now for 2009. If you never shorted the market before or engaged in short selling, you probably shouldn't even worry about trying to short the rally. What you should do is focus and educate yourself on how not to make the mistakes you made last year, so once you do get in stuff that's going to go up again, you don't make the same mistake that you sell out at a good time, because it's useless if you get great stock picks or get in at the right time if you never sell, because one day there's going to be another bear market, and you've got to learn how not to make the same mistake you made last year if you made them, or any other mistakes you may have made. And we've all made mistakes. I made some mistakes myself. That's trading. That's investing. You always have to educate yourself and learn. So that's what you need to do. And the new strategies for 2009, as I said, to sum up, consider shorting one more rally, market timing strategy for one last time, but not necessary if you've never done it before. And once we're halfway through stage 1, my strategies of switching from market timing to sector timing are going to be important. That's what I'm going to do. And that means to buy individual stocks in the top sectors of the market when those sectors make the transition out of stage 1 and into a new bull market. Ignore my typos and stuff, because I really did this writing for myself to help organize my thoughts. And here's the thing, I want you to be a little, I know people have been beaten up last year, and you've been beaten up last year. It's easy to get discouraged about the stock market, and I know most people are simply burying their head in the sands, and they've lost hope, and the important, the real damaging thing is not the actual loss in your accounts. It's the damage you can do to your mentality and hurting your confidence when it comes to making money in the market. And that's the thing that is going to make people miss out on the potential that's ahead of us. And the profit potential is enormous if you understand how to buy it towards the end of stage 1 and understand how to buy the right sectors. So in the next video I put out, I'm going to explain this in more detail, how to do this, and I hope you benefit from this video, and I'll be talking to you in 2 days, or 3 days maybe. But talk to you later.